Okay. Good morning, good evening, everybody. Here, greeting from Taiwan, and I think most of the audience are United States. So let me just allow me to give you guys a brief introduction to DAC, Data Analytic Colloquium. This is a colloquium that Professor Ho and I, and then we try to pull the things together, and we try to invite the top-notch scholars in data analytics, including today's our special guest, Andy Phillips, Professor Andy Phillips from U of Colorado and Boulder. So previously we have invited a few, I think there's very well-known scholars and in this area. And this is just our first semester to run this program. We're hoping that in the future we're going to invite more well-known scholars, top-notch scholars, and to share their research and their projects with all of us. Actually, we already have a website, a Data Analytics Colloquium. Welcome to visit our website, and we have previous recordings of the previous speeches. So welcome to visit us. And actually, we have the YouTube channel too. Professor Carl Ho have pulled things together, and if you ever have if you missed previous speeches, welcome to go to the channel and enjoy the speeches. I think that's very insightful, and including today's, we're looking forward to Andy Phillips, Professor Andy Phillips' speeches today. So I think that's if you need more information, please visit our website, and I think you can get more information from there. So I'll turn the mic to Professor Ho. Would you like to introduce Professor Andy Phillips to every one of us?
Sure. Thank you, Peter. Thank you for the introductory note. And allow me to introduce myself. My name is Carl Ho. I'm the co-host of the Data Analytics Colloquium. And today, we are so privileged to have invited Professor Andy Q. Phillips. And Dr. Phillips is assistant professor at the University of Colorado Boulder. And he regularly teaches political methodology courses and at both graduate and undergraduate levels. And he is one of his most cited articles is about time series. So he had an article in AJPS talking about how you can determine what time series method you should use. Naturally, he is really prolific in his research, and he has published in the top journals like American Journal of Political Science Research and Methods, Political Research Quarterly, Public Choice. Now, the journals most political science or data scientists love to get a name on. There are our journals and the State Journal. Those are really technical but really good journals. I think you can call him a data scientist, a political scientist, and also software developer. He wrote a few applications also. I think without further ado, allow me to introduce Professor Andy Phillips. Hello, Andy.
Hi. So I'd like to thank Peter and Carl for having me. I'm very excited to be here. Yes. Can you all see that okay, I think?
Yes, great. And then we can see, can you make it into full screen? Yeah.
Yeah. Is that full screen now?
Still, I think it's not the full screen. Can you zoom in a little bit? Maybe is this a keynote, right?
Yeah,
keynote,
sorry, let me do the...
That's okay. And for those who, I will put Dr. Phillips' a keynote in the colloquium GitHub. I will give you the link. It's perfect now. It's perfect. Thank you. Yeah, please.
Perfect. So again, thanks to Carl and Peter. I'm really excited to be here. I'm a little bummed I can't be either in Taiwan or Texas, warmer places than Colorado this time of year. But anyway, I'm excited to talk about almost like two different papers today, but that are closely tied together. And so really they have to do with how elites affect financial markets. I would be remiss if I didn't mention my amazing co-author. Allison L. Benton is a professor in the political science department. I think it's actually an international relations department at the City University of London. So her and I have worked together on a bunch of projects, and we're still going strong. So our question here is really, do elites matter to financial markets? And I think the easy answer is yes, they do. But we're going to dive into some specifics. So, on the top left, we have Boris Johnson with a scary looking hammer. And then we have Abenomics, which was supposed to, really build Japan's economy. So I think the answer to this is yes. And I think a lot of political science research, of course, has focused on mostly how does the economy affect the re-election prospects or things like presidential approval or parliamentary approval of incumbents. So we have Ross Perot down on the bottom, George H.W. Bush with a Ross Perot newspaper down on the bottom. There's some work by Kaiser and Perez that show, it's not just local economic growth that's affecting how well incumbents do, but also the growth of neighboring countries and things like the unemployment rate. So yes, it's clear that the economy affects elites. And we know to some extent that, at least from the news, right, anecdotally, that unexpected events can help or hurt them. So Jacinda Ardern was just reelected by really high margins, her entire party in New Zealand. And, it wasn't around election time, but of course, the Hurricane Katrina in the US really hurt George W. Bush in terms of, what people thought, because that was assumed to be mostly mishandled in the aftermath. So really, this is how incumbents are responding to certain events. Our question is slightly different than these two, is really how do elites affect financial markets? And we're going to do this in two different ways. The first is a paper that Allison and I were working on that just came out this year, and it's how elite speech may send signals to financial markets. The second one, which is closely related, and this is what we're currently working on, is if the response of elites to unexpected events may also send signals to markets. So really, an event comes along, how do incumbents handle it? And how they handle it, or how they maybe change their policies of handling it, will affect markets. So just to summarize everything that I'm going to talk about today is really a twofold. So looking up at the top, speech by elites, we find not only affects financial markets when it's unexpected, which is what a lot of existing literature and economics would tell us. We also find that it continues to affect markets if it's showing the government's resolve to particular policies. So looking at those pink circles in our plot here, it's not only unexpected, unanticipated.
Sorry, Andy. Somehow I did not see your screen change, and it's still staying on the first page.
Oh, sorry.
So maybe something to do with. Yeah, we can see it now. Okay.
Okay. I'll just.
Okay.
Is this okay here, like this?
Yeah. I can see that. That's the second page. Yeah.
Sorry about that.
Yeah.
All right. So,
sorry, that should have remind you. Okay, go ahead, please.
No, that's fine. Okay, so everyone can see this now. All right, so there's our Boris Johnson picture. Here's them affecting the economy. Right, so this is basically what we're trying to show here today. So, right, it's the top part is not only these unexpected unexpected speech and events that are happening that affects market volatility, but it's also this term of government policy resolve that we come up with. The second part, which is the stuff in yellow, is our new work. And so that's just showing that it's not only events that are affecting markets, but it's also speech related to how the government is responding to those events. So all these things are closely related. To some extent, they're slightly different than one another, but we're going to talk about the pink part first, and then we'll move to the yellow part. So the first part, again, just to summarize, is that elite speech and policy resolve sends signals to markets. So on the right, we have a tweet, which we'll get into in a minute. But basically, Allison and I started this paper looking at the following. So her and I were talking right around the 2016 election, and depending on the news that you were reading, you saw a lot of articles that seemed to argue that Trump's tweets, which if you've heard of Twitter, he's a prolific tweeter. There were a lot of arguments that his tweets were affecting certain things. So one of these was actual stock market prices of certain companies. So there's been some work on that. And then there were arguments about the market in its entirety. So really, he would tweet and the markets would react. Of course, the other side, and again, based off economic theory, would suggest that these tweets don't really matter, right? So we know how Trump, what Trump thinks about certain policies, and assuming that markets are efficient, everything that we need to know about certain prices is basically already priced into the price itself, right? So there are a lot of these contrarian type news articles saying, don't listen to Trump's tweets. You certainly shouldn't trade off Trump's tweets. He's not actually affecting the markets. So we get these two conflicting news stories right around the time of the election. So I briefly just mentioned this, but here it is in a more theoretical diagram. There's a literature in political economy about efficient markets. The simplified version of this is right. What's predicting the asset prices at a given time? It's a function of the prior asset prices, which is that itself was predicted by old information. New information, right? So this is stuff that is new and unanticipated, and that's going to cause the asset to change in price, and then this will lead to financial market behavior, right? So basically, unless there's new economic news, that causes investors to react. And then if there's new economic policy news, so this would be things like a new tariff or, right, like a new trade policy of some sort, that could also cause markets to react. Again, if that stuff is not happening, these asset prices shouldn't really change. So this is the dominant literature that exists so far. So what are some of these examples of like unanticipated policy changes? So there's some instances in, I'm saying here political economy, but really these are all political scientists, and looking at both election periods as well as election processes. So there's some work by LeBlanc, Bernhard and LeBlanc, Freeman, Hayes, and Stix, among some others. And really that's saying that as time grows closer to an election, that is a period of uncertainty. So markets don't know who's going to win. And that should cause asset prices to either change or cause uncertainty in the markets, which has the effect of producing volatility. So really, it's like unexpected movements in different asset prices. Other articles that have been written focus on election processes. So some of this is concerned with who's going to win, right? So traditionally in U.S. politics, if a Democrat was going into office, the markets might react more negatively than if they think a Republican is going to go into office. And so, again, this is some sort of uncertainty about who is going to win. And then finally, when it happens, the markets will end up adjusting. So if we were to take the existing literature, we would evaluate Trump's policy views as follows. So the traditional argument would say that when his policy views were unknown, anything that he tweeted about that could possibly affect markets should matter to markets. So investors will be paying attention. Of course, once we know Trump's policy views, the efficient market hypothesis would say that tweets really shouldn't matter to financial markets. Kind of building off of this, though, there is a little bit of literature on the candidate type. So I mentioned briefly about like certain partisan differences. There's also a small literature on whether a candidate is known. So basically, we know what their economic policy is going to be, or unknown. And so Trump, of course, is a good example of, right, this is an unknown candidate, never run for political office. Policies, in some ways, are really conservative and liberal. It was just really unclear what type of policies he would have. And so this kind of leads a bit into our new innovation of what we call candidate policy resolve. And so you basically have to have, one thing, and that is a unknown candidate who either wins or is eligible for winning, so they're running. And then basically what we argue here is that his tweets, right, signal how committed he is to a certain policy after his policy views are known. So I know this is kind of like it's theoretical, but it's not applied yet. So I'll give you a good example of what we'll look at. But basically, this is arguing that, right, efficient markets would say that tweets should matter up until policy views are known. We're arguing that tweets should matter until policy views are known and afterwards because they signal this commitment or resolve. So our updated version of this, it looks as follows. So what's the new difference is it's not just new economic information, it's also new information about policy resolve. So this, we still think this kind of fits within the efficient market hypothesis, but it's slightly different. So this is our innovation here. So just to compare what we would have thought just based off in gray there, that would be the efficient market hypothesis, right? We said that when Trump's policy views were unknown, tweets should matter. Once Trump's policy views are known, tweets should not matter. We're arguing that tweets should matter both before and after his policy views are known because of this policy resolve argument. So we've talked a bit about this, right? But our empirical strategy, and then we'll dive into the data here, is looking at Trump's tweets and the US dollar Mexican peso exchange rate. So I showed you a few articles earlier about Trump tweeting and affecting the stock market, which we'll kind of get to in our next topic. But right, just before the election and during the election and after the election, Trump was tweeting a lot about Mexico. So once again, we see lots of arguments saying that the peso is reacting to certain tweets. There was a joke. Allison used to work in the financial sector, so she has a lot of good articles and friends who gave her quotes for our paper. So there was this joke that it would be cheaper for the Mexican central bank to stop defending the peso and just buy Twitter and shut it down. So there's some fun articles that we read looking through here. And so our argument here, right, is the efficient markets would say before the 16th of June 2015, his tweets should matter because he had talked about possibly running, but it wasn't established. He didn't have a website or anything like that. And then after the 16th of June, his website went up and his policy views were, you could go and look it up basically. And you probably guess this as well, right? But what are his views? So on immigration, some of his tweets say things like, when Mexico sends its people, they're not sending their best. I will terminate President Obama's illegal executive order on immigration. I will build a great, great wall on our southern border, and I will have Mexico pay for that wall. So all of this stuff, right, should be bad for the peso. It's just a question of whether do all these tweets matter before his views are known, or do these sorts of tweets signal his policy resolve, really his intent to actually carry out these sorts of things. NAFTA was the other big, big topic that he talked about around this time. So really bringing jobs back from Mexico, renegotiating the trade deal with Mexico and Canada. So these were all like commonly discussed. So our empirical expectations, given what we do is we split the time series that we have into 5 different points. The first one is the pre-primary candidate. So this is when, according to the efficient market hypothesis, Trump's tweets about about Mexico should actually matter. Given efficient markets, we would expect that after he was a primary candidate, after he became the Republican nominee, after he won the election, and so during Obama's lame duck period, and then once he became president, his tweets shouldn't matter at all to markets. Our argument, of course, is that these tweets should probably continue to matter because of this policy resolve. So what we end up looking at is volatility. I'm going to go a little bit into depth here in discussing it because we're also going to use this in the next section as well. So it turns out that it's really hard to predict currency or stock market price levels. A lot of times, again, the information is fully priced in. So instead, what we're going to look at is currency price volatility. So what this is going to be is unexpected changes in the peso, right? So it would be things that we can't really predict, and we'll actually see that his tweets predict these unexpected fluctuations. Why does volatility exist? In the finance literature, there's a few ideas as to why it exists. One is heterogeneous investors. So we actually talk in our paper about noise traders, right? So these are people that would look at a tweet and say, oh, I'm going to hedge one way or the other. A lot of times what happens is you'll see some people will hedge up and then just as many people will hedge down. And so they cancel each other out. But what you'll see is these asset prices will move really unexpectedly. Same thing too with expectations, investor types. I mentioned these day traders or noise traders, and then also just investment strategies differ as well. So really the focus here is if there's a divergence in expectations about the asset price, we should see volatility. We don't look at it. It's hard to get this measure all the time, but we would also expect that there be an increased trading volume as well. So we think that the peso should become more volatile as Trump provides a Mexico-related tweet. So our dependent variable is going to be the percent daily change in the US dollar Mexican exchange rate. We need to take the percent daily change because if you look at a time series, I think I'll show you on the next slide. Basically, the peso is just depreciating throughout this entire period, so it's pretty non-stationary, and so this just ensures that it's stationary. Our independent variables, I'll talk about in a minute here, and then the other important part of this argument are these time periods, because we said efficient markets said that his tweets should only matter in the pre-primary candidate phase. So that's the 1st of January 2015 through the 16th of June, 2015. We're arguing that these other periods should matter as well. So again, in these U.S. races, there's this primary candidate phase. During this time, there were a ton of primary candidates running for the Republican Party. Trump ended up getting the nomination on the 19th of July, 2016. And so then he's the Republican nominee running against Hillary Clinton. He wins the election in November 2016, and then he's president-elect. And then on the 20th of January, right, then he takes over and becomes president. So just to give you an idea of what the exchange rate looks like and what we're modeling, the top level is the actual exchange rate. So like I said, for the most part, the peso, it takes more pesos to buy a US dollar throughout this period. And then we're going to look at that bottom section as well. So that's going to be the percentage change in the peso. You can see it fluctuates quite a bit. And there's certain periods, the big spike is the election. But there's some other big spikes as well. So we're really trying to model not just those spikes, but unexpected volatility in those spikes. So here's our independent variable. So this involved a little bit of work getting the data ready. So we're going to start at the top left. The top left was we grabbed every tweet that Donald Trump gave from January 2015 through February 2018. That was about, I think it was 14,500 tweets or so. So he tweets about 13 times a day. I maybe tweet, once every other week. So he tweets quite a bit. The next thing that we did was we grabbed tweets containing Mexico-related terms. I'll show you what these are on the next slide. But these are things like trade, NAFTA, wall, peso, Hispanic. So he was talking about certain Mexico-related things. So examples of this, he tweets, "We need a wall, not a Rubio," referring to Marco Rubio. So that would get picked up, right? Because he's talking about building a wall. Many Hispanics agree on enforcing the border, Trump for president. So border, we would have picked up there. So we would have grabbed that tweet. What you should really be angry about is the invasion of millions of illegals taking over America, not Donald Trump. So illegals would have been the thing that we would have picked up there. And if we run through this, out of all of those tweets, there's about 697 that are potential Mexico-related tweets. From those, there weren't a ton of them, so we just went through by hand and took out any misclassified tweets. A good example of this is the Wall Street Journal stated falsely that I said to them, I have a good relationship with Kim Jong-un of North Korea, right? So wall we would have picked that up because it sounds like a Mexico-related tweet, but of course, it's just the Wall Street Journal, so we would take that out. So when we do that, we end up with 438 Mexico-related tweets. He tweeted those tweets over 239 days, and we have a total time series of 804 days. So, I think this is something to think about is this is not like a sparse independent variable. Out of our 104 total days, he's tweeting about a quarter of them. So it's happening quite a bit. Here's our subject tweets. So these are the subjects that we used when we went through all the tweets. What does he talk about the most? Well, about, I think it's 12% of the days in the sample, he's talking about the border. He also talks a lot about illegal, either immigration or illegal aliens. He talks a bit about a wall as well. He talks about immigration, and then trade is the next biggest thing, right? So there's kind of these two things that he's talking about. One is about immigration / building the wall. The other part is about NAFTA, trade, the TPP. So in the paper, we kind of separate them out into like immigration versus trade. But I can talk about that if you want later. This is just a time series of how often he's talking about Mexico-related tweets. And what we'd want to see here is he consistently talking about Mexico-related tweets throughout the entire time series? So these are monthly counts of our keywords. And for sure, he's talking the most about it when he's a primary candidate, as well as before he's a primary candidate. But he's still talking a lot throughout the entire sample. So this is just, right, a sanity check of we want to make sure that he's actually continues to talk about these policies. I'll go a little bit into depth about our modeling strategy because it's going to be the same for the next our next topic as well. So what we end up using to model this is something called a generalized autoregressive conditional heteroscedasticity, which is a mouthful. So it's easier just to say a Garch model. So these are commonly used in financial time series because we typically have a lot of data. So we have 800 observations. And what we're trying to do is not model the value of the peso. We're trying to model, remember we talked about like volatility in the peso. So that's really unexpected changes in the peso. What is a little bit different here is really we have both what's called a mean equation, which is what you're used to always, right? If you run a regression, that's the mean equation. So that's trying to predict the expected value of y. And then we also have this variance equation as well. So our mean equation involves our dependent variable, remember, was the percentage change in the peso. That's going to be a function of a lag-dependent variable because, of course, we think changes over one day are probably correlated with changes over the next day. A set of economic and financial controls. So these are things like stock market indices, bond spreads between the U.S. and Mexico, interest rate spreads. I mentioned the central bank, joked about buying Twitter. The central bank of Mexico was doing a lot of interventions, right? So they're constantly buying or having to defend their currency. We have a set of political controls. So these are our election period dummies, is what we call them. So the baseline category is the pre-primary period before he announced that he was going to run. We have the primary candidate period. We have the GOP nominee period. We have the president-elect period, and then we have the president period. We toss in some dummy variables for the presidential election. And then during this time, too, after he became president, there were a bunch of NAFTA rounds when it was being renegotiated. We obviously think those probably affect the peso, too. Our key independent variable is that tweet dummy. So this is going to be a dummy variable equal to 1 on a day that Trump issued a Mexico-related tweet, right? So we think that's going to affect the peso. But if you remember back to our theoretical table, we think that should matter at certain points in time. So what we're going to do, you'll see, is we're going to interact that tweet dummy with each of our time periods in our model. So we're just going to have a bunch of interactions, and then I'll show you what they look like. So, right, that was the expected value of the peso. We don't think tweets should affect that. We think tweets should affect the variance. So what this is
quick question, Andy. So the pre-primary is the base category.
Yeah.
Okay. Thank you.
Yeah, good question. So the variance equation in these arch models is, if you think back to OLS, is when I estimate OLS, I get estimates of all my coefficients, and I get an estimate of sigma squared, which is the variance around the error term. So that's the exact same sigma squared that you see here. There's two differences. One is it's a dependent variable, it looks like. And the second thing is you can see a little t subscript which is saying that I think the error variance is changing over time. So that is, right, that is basically volatility. So what this is saying is at certain points in time, that I'm going to do like better or worse at predicting values of the peso. So like, again, if you haven't seen this, it might look a little complicated. Things will get easier in a minute here. That's going to be a function of what's called the arch term. So that's the omega 1 epsilon squared at t minus 1. So this is like saying in the previous period, if there was a big unexpected shock, I expect that to affect the error variance one period in the future by coefficient omega 1. So we would probably expect it to be positive. The other part is this alpha times sigma squared at t minus 1. And that's really the lagged time varying error variance. So it is like a lag dependent variable, where our dependent variable here is the error variance itself. So, if you're familiar with models with a lag dependent variable, right, we would expect this to be somewhere between 0 and 1. That's like saying previous, right? It's basically previous volatility is kind of persisting across time. So this is our Garch model here. So the epsilon squared is called an arch term, and then the sigma squared t minus 1 is called a Garch term. That is all in good, right? But here's what we want is we said that tweets should affect volatility in the peso. And so at the very end of this equation, you see exp of z sub t times gamma. So what these are is basically we think that there's certain independent variables that are going to affect volatility. Volatility really just is sigma squared sub t, which is just the error variance itself. So that's going to be a set of economic and financial controls. So that's the stock market index and a bond spread. And then we're going to toss in all of those tweet dummies and interactions in here as well. I'm taking the exponent because I know that variance is always positive, right? So that'll ensure that I just have a positive value here. I will quickly show you this big ugly table, and then we'll move into something that Allison and I came up with to hopefully make things easier. So we get a lot of results, right? Because there's really two equations that we'd have to interpret. The mean equation, as expected, tweets don't matter at all, right? So tweets aren't affecting changes in the peso. We really didn't think that they would expect, that they would. The only thing really worth discussing here is you can see that the presidential election really mattered, right? So that's a positive coefficient, meaning that the peso devalued, right? So, it takes more pesos to buy a dollar, which is exactly what we would expect. The variance equation, a few things to look at. So the arch terms we said were previous unexpected shocks to the peso. How does that affect volatility? It looks like those are positive and mostly significant. The Garch term we said, how does volatility persist across time? So it looks like volatility, because those coefficients are close to 1, volatility is relatively persistent across time. And then so we just ran equation 2, just shows none of those independent variables, just, as a baseline model. Equation 3 includes the tweet dummy, as well as our time variables, and also those economic variables. And it looks like tweets on their own don't matter. If you look at equation 4, though, that's where we interact tweets with these presidential periods. And we see that it looks like the coefficients, sometimes appear to be positive. Here's our problem, though. So I can go ahead and interpret this just like I would I'd say the thing that's probably most similar to this would be like almost like a logit model or so, right? Where a positive value would make things more likely. Here, a positive value is increasing volatility. A negative value is decreasing volatility. That's about the extent of all I can tell you if something's significant or not, but that's about it, right? I couldn't say, that coefficient of 0.972 is not a 0.972 increase in volatility. Why? Because you can see, right, it's Z sub t times gamma. So if I were to say, give me a prediction of what volatility is, I would need to know every single value of Z, multiply by the coefficients, take the exponent, and then I could tell you what sigma squared was. So again, like it's most akin to the logit model, right? Where if you wanted to create a predictive probability, you would need to know what every single value of your independent variables was. So Allison and I were looking around, and it turns out that people just interpret those tables, which is kind of limiting. So the next thing that we did was we thought, well, what if we could make some sort of graphical depiction of volatility? So what we end up doing is a stochastic simulation. Basically, it's like a parametric, a bootstrap. So given our model, we're going to draw, say, like 1,000 estimates of these coefficients. The average value is going to be whatever our estimates are, and the variance around those coefficients is going to be based off the variance covariance matrix that we estimate. If you've ran Zelig, if you've ran in R, if you ran Clarify and Stata, that's probably the most similar to what we're doing here. And then what we're going to do is with those, and again, during the Q&A, I'm happy to talk about this more because this is something that we're still working on. So what we're going to do next is hold our continuous variables at their means, hold our dummy variables at 0, and then let's see what happens if we're moving along in time, we're calculating our expected volatility, and all of a sudden, right, our counterfactual is that Trump gave a tweet on day 3, what would happen? And this is really what we get. So I think if you find the Garch stuff hard, we're trying to make it a little bit easier to see like what is the actual volatility that occurs. So this is using equation 4 from a few slides ago. The y-axis is our expected conditional error variance. So that's the sigma squared sub t. Another nice way of thinking about it is its volatility, right? So higher levels mean bigger uncertain fluctuations in the peso. Lower levels mean less fluctuations. So what do we see? It looks like if Trump were to go along and nothing happens, and all of a sudden he tweets on day 3 and day 3 only, in the pre-candidate period, it actually doesn't seem to matter at all. So that's kind of going against the efficient market hypothesis. When he's a primary candidate, maybe it's a slight decrease. It doesn't really seem to matter. When he's a GOP nominee and when he's president-elect, then it seems to increase volatility. And I guess something else to add here is, why does the volatility increase and then kind of trickle down again? It's because of that Garch term, right? So it's really like a lag-dependent variable term. So not only does a tweet have a immediate impact on volatility of the exchange rate, it also takes a while for volatility to like die back down to where it was before. So some other things that were fun that we looked at. We thought maybe if there was like a flurry of tweets, right? So like an intense day of tweeting, maybe that would rattle markets even more. And it looks like it kind of does. So what we did was we coded whether he tweeted just once or whether he tweeted 2 or more times. And so the blue circles are him just tweeting once. The red squares are him tweeting 2 or more times. Right. when he tweets a lot about Mexico, it seems to increase volatility even more. So expected, right? But it kind of makes sense.
Mm-hmm.
Other things that we look at too here is we're looking at retweets and favorites. So, it could be the case that if someone either likes his tweet or retweets his tweet, right, that's kind of amplifying the message about these Mexico-related policies. So maybe that matters. So what we did was we coded blue was just, the average number of retweets across the sample, and then red was in the 90th percentile. It increases volatility a bit more, but not very much. So
Mm-hmm.
so it doesn't really seem to matter all that much.
Mm-hmm.
So just to finish up this part, and then I'll go on to our next big topic here is, right, what did we find and how does it compare to what we would have done had we just thought about the efficient market hypothesis? So remember, our argument was that volatility should occur in every period. For the most part, we find that volatility happens in the pre-primary period, in the GOP nominee period, and in the president-elect period. Our best argument for this is, in the primary candidate field, like there were so many people running, it wasn't really sure if he was going to win or not. For a while he was kind of like a joke candidate, and then it started becoming more and more serious. And then when he was a GOP nominee, our argument there is like all of a sudden everyone's looking to try to get all the information they possibly can about what his policy is going to be, and then also how committed he is to these Mexico-related policies. Same thing too when he's president-elect. After he became president, these effects seem to just disappear. We haven't updated this past 2018 though.
Mm-hmm.
So, right, we're doing a little shift over. So what we found was that policy resolve affects markets, but we're going to see how else policy might matter in terms of policy responses to unexpected events. So again, I feel like Allison and I just read the news and then we come up with paper topics. So what we noticed this year, of course, is news is focusing a lot on government responses to coronavirus, right? So they're making some sort of evaluation of, right, here we have Boris Johnson's coronavirus optimism hits testing reality, right? So, his policy promises aren't living up to what people are expecting. These promises of the economy roaring back after coronavirus, you saw a lot of this talk in like the late spring, especially in Europe and the US. We have Bolsonaro in Brazil, right, who called it just a little flu, and then goes on to get COVID, right? So we see lots of policy responses that basically like promise something about coronavirus and then either don't deliver or kind of make promises that aren't realistic. And then, in Brazil's case, right, they're taking on a lot of debt that probably will cause some sort of crisis in the future. Same thing in the US, right? That's not true everywhere. So again, certain countries obviously have had issues. I know, I think Canada, I think I read today, is taking on debt faster than any other country right now. So there's still problems, right? But certain leaders were certainly more realistic in terms of like what to expect, set policy responses of government that hasn't really changed all that much. So this event of coronavirus, obviously there's no literature on coronavirus yet. I'm sure there's a lot of papers being written right now. But we do have a literature on how major violent events affect financial markets. So there is a lot of literature on if there's a violent event in a country or near a country, there's a direct impact on human losses, capital losses, and and so obviously that could affect markets. Costs and levels of business change, right? So kind of a little ways down the road, it becomes more expensive to do business. Firms and individuals will change their spending and investment habits. All those things, right, are affecting markets. This could lead to bigger, like, macroeconomic prospects of nations. So this would be things like possibly debt downgrades, having to go under IMF conditionality, certain agreements, things like that. And then, of course, investors that have either assets in a country, or are hedging against certain currencies in a country, right? They're going to change their views about their assets too. So the literature, pretty much resoundingly says if you're a country and you have a violent event, that's going to cause market losses. And then, similar to our last story, it's really going to cause a lot of volatility, right? Because some people will kind of hedge that, oh, well, maybe it's not that bad. That has the impact of just creating a lot of uncertainty. So examples, especially in the conflict literature and international relations, are looking at things like military attacks on what happens to markets and volatility, terrorist attacks, things like natural disasters and weather. So something that's a little bit more possibly exogenous as well. So lots of literature on these violent, unexpected events and how they affect markets. So our innovation here is really that we think that government policy responses to major violent events should also matter to investors. So all of that literature, right, the independent variable is a violent event. So it'd be something like a terrorist attack or how many fatalities, right? There's no middle step of how is the government responding to this event, right? So, from what we've seen in the literature, that intermediate step is basically missing. So what we're arguing is violent event happens, government responds, that's going to affect investors. Why? Given our newspaper examples, governments could either respond relatively coherently, so meaning that they have a policy, the policy doesn't really change very much. Hopefully, right, that would shorten the economic impact of the actual event, or they could respond more incoherently. So this would be a lot of flip-flopping back and forth about what policy should be, lots of changing policy, lots of different actors within a government saying slightly different policies, right? So those are all things that should maybe prolong the economic impact of these events. So given that, right, we couldn't really find anyone talking about this policy coherence or incoherence and how it affects financial markets, there's this missing causal link here that we were trying to explain. So places where we looked for this, in the psychology literature, there's a lot of literature on cognitive dissonance theory. So really where people are facing conflict between different cognitions. So these would be, their prior attitudes or prior beliefs, actual actions or behavior, and then incoming knowledge or information. And what they'll really try to do is adjust these dissonant cognitions. So that's just in really broad literature. Applied to our purposes here, argument is that politicians themselves could possibly face this dissonance between policy cognition. So these would be things like, what types of attitudes or beliefs in regards to a policy do they hold beforehand? How do they actually behave in response to the policy? And then particularly in response to COVID, right? What's the sort of knowledge that they're either taking in or starting with? And how is that possibly changing policy? So once again, what we'll see is that, given these three things, politicians will possibly adjust these dissonant cognitions. And these adjustments, right, of policy should create policy uncertainty. and we'll argue go on to affect markets. So, right, we think that government policy dissonance creates policy uncertainty. So that's one half of the arrow, right? Second half of the arrow is, does policy uncertainty affect financial markets? Yes, so we already talked about this, right? So things like upcoming elections, not knowing whether the Democrat or Republican will win, something like an unknown candidate. Other examples that I didn't talk about were things like cabinet scandals or resignations, or political summits or negotiations. So these are things that, right, I know they're coming up. I don't really know what the outcome is going to be. It's going to cause some amount of uncertainty. So it appears that the literature basically already answers this part for us, in that policy uncertainty should cause financial market losses and definitely cause increased volatility. So our argument here is that government policy dissonance in response to a major event will cause policy uncertainty, and then this policy uncertainty will go on to affect financial markets. So, this is just words of what I just said, right? So this dissonance is going to make it more likely that policy attitudes or actions shift. That's going to create investors' uncertainty and possibly, their concerns about the impact of this event, and it's going to cause volatility to increase. So once again, we have our guinea pig of Donald Trump. We're going to look at his COVID policy responses. So we're just going to look at 2020. What is nice about this research design? It holds structural, political, and financial characteristics constant. So unlike the previous topic, right, we don't have a huge time series here. And basically our time series is over because he's not going to be president for much longer. But COVID is nice because it's pretty exogenous to financial market dynamics, right? So market dynamics are probably not causing more people to catch COVID, right? It's the other way around. Similar to Trump's Mexico-related statements, he very much expressed regular COVID-19 policy attitudes. And, which is going to be key for our argument, it wasn't just Trump that talked about this. It was other governments and other government agencies that also talked about policy actions and recommendations. So, I think a lot of people think of like Anthony Fauci, right, as the CDC advisor, coming on and talking about certain government policies. And this is just a nice qualitative example of Trump oftentimes either conflicted with what he said or said that he wasn't right, and so we get this like dissonance happening. And so we do think of a lot of anecdotal evidence that this is actually what was occurring during this time. All right, so once again, we're going to do a fun data construction here. So with this one, we're not going to look at tweets, although we have a little bit of stuff that we've done with tweets on this. Instead, what we're going to look at is nice long text, because we want to get sentiments, right? So is Trump's discussion of a COVID-related topic on average, positive, or is it negative? And is it dissonant to other things? So what we ended up doing was we web scraped all 2020 speeches, remarks and announcement from whitehouse.gov. So anything that Trump says in terms of remarks, I don't think rallies are up there, but remarks, announcements, press briefings, they're all up there. So there's about 1,500 of those. We then split it into paragraphs. So we had pretty close to 87,000 short paragraphs of text. The next thing that we had to do, which is a little messy, is trying to get Trump's remarks, right? Because we at least want to ID when we think it's him talking. So there's a few ways that we did this, but this would be clearly looking through things like, we want to get rid of whenever the press is talking, right? So if the press is asking Trump a question, we don't want to include that. There were other people that are included on this White House data set. So someone like the press secretary, the first lady speaks every now and then. Trump's doctors were speaking a lot when he got COVID. So we're just getting rid of all that stuff. The next thing that we did was we ran it through a COVID dictionary that we created. I think a lot of these things, right, like we could sit here and come up with a lot of COVID-related terms. So Allison and I did that. We also looked at the Canadian Health Ministry, had a list of COVID terms. And then Oxford, I think the Oxford Dictionary puts out a monthly corpus of, I think it's like the most searched for things online. And it was most searched for things online related to COVID. So these were like month by month different terms that would pop up on searches. So examples would be, like at the beginning, there was talks of like COVID-19, virus, disinfectant. Then it became more like quarantining. Now, of course, it's things like vaccine. So it was just a nice way of picking up different terms. So all told, we had about 210 terms. And so what we're going to do then is feed all those paragraphs through the dictionary and then tag, is this paragraph a COVID-related paragraph or is it not? So an example here would be a press briefing he gave. Let me begin with a brief update on the China virus. Over the last month, our new cases have declined by 38%, and so on, right? So something like China, virus, cases, testing, tests, right? That would get picked up. So we would include that paragraph and say, this is related to COVID. Then what we did was we obtained the sentiment of any tag text using just like a common lexicon. So what this is going to do is higher values of sentiment are going to mean that the text is more positive. Lower values are going to mean that it's more negative. And then we also kept what are called valence shifters. So that would be like if he said very bad, that would mean it's more negative than if he just said bad. If he said not bad, right, that's the opposite of bad. So by including those valence shifters, it kind of does a better job of the sentiment. And then we turn, right, so that's like kind of still abstract text. And then what we ended up doing was turn it into a time series. So we created the daily average of sentiment for all COVID-related speech given by Trump's remarks. So these are more like off-the-cuff statements that he gives. And you can see the time series over on the bottom right. So again, higher values mean that the speech is more positive. Lower values mean it's more negative. We tossed there's a lowest, the dotted line is like a lowest smooth line. So you can see that maybe he's gotten more negative over time, but not by all that much, right? But for sure, from day to day, right, there's lots of changes in terms of this tone. So, right, our theory is that it's not the tone that matters. Our theory is it's the dissonance that matters. And I'd be interested in the Q&A if you all had some thoughts on other ways that we could measure dissonance. We thought of a few. So one would be if Trump is actually dissonant to himself, right? So an example of this would be the daily change in COVID-related sentiment, meaning yesterday, right, is Trump more or less positive on COVID-related statements? If there's a big difference between each day, that could produce volatility. We also look at, I talked about COVID dictionaries. We also tossed in, we have an econ dictionary too, and a few other dictionaries. So we are also going to compare, is his sentiment on average in a given day more positive or negative relative to his sentiments on economic related paragraphs? So, one of these two might be it. I don't think we have a reason to expect one over the other. the other big group of dissonance measures that we come up with are two people who also appear a lot in those White House texts. One is Mike Pence. And so we have a pretty strong reason to believe that investors might be paying attention to Mike Pence because he's the head of the coronavirus task force. So we might think that if Trump's COVID sentiment is high or low relative to Mike Pence, that's a form of dissonance. And so that should affect volatility. The other person who gives a lot of press briefings is his press secretary, Kayleigh McEnany. So same thing, right? If she's saying something and that sentiment is really out of touch with what he's saying, that should also cause volatility. And then what we end up doing is we examine both direction. So, right, is he more positive than, say, someone else, as well as absolute value? So this would be like, are the two different, with no sense of like, is Trump more positive or more negative? So both we see kind of matters. Once again, right, we're going to run these Garch models. We do find evidence of Garch effects in our data. Our dependent variables are different financial indicators. So we look at the daily percentage change in the NASDAQ stock index, the New York Stock Exchange Index, and the S&P 500. We're going to take the lag of that. We have our dissonance measures that I just talked about. And then we also include some COVID-related terms. So that's the change in deaths, and then the change in daily cases in the US. And then just like we saw before, we also have this variance equation where we're going to stick in our dissonance measures because we think that, right, these dissonance measures aren't going to affect the level of the financial indicators. They're going to affect the volatility. Right now, this is still like kind of early work. So we have a pretty parsimonious model. We haven't tossed in all those other economic controls yet. So that's where we're going. So I'll just show you a few, I know we're running out of time here, just a few quick examples. Mm-hmm. The first one is that temporal dissonance that we talked about. So the bottom right is showing us the day-to-day change in sentiment relative to the previous day, right? So if it's positive, it means that Trump's COVID-related discussions are more positive than they were yesterday. If it's negative, it means that he was more negative today than yesterday. And then on the left, the bottom left, you can see the absolute value. So there's days when, what he talked about yesterday is really out of step with what he's talking about today. And we'll do the exact same thing that I talked about before. So we'll just plot these volatilities because they're a little bit easier. Both of them look like they increase volatility. In the tables, both are statistically significant. One thing to look at is the y-axis is really small in magnitude. So, it's maybe a little strange, but in relative terms, these are big changes, right? So if on day 4, if he has a dissonance increase of, it says 1 standard deviation, but it should be 2 standard deviations. So if he were to become 2 standard deviations more positive than he was yesterday, that has an effect of increasing volatility by about 43%. Right. So these are, big shifts in volatility in the S&P 500. Mm-hmm. Dissonance measure 2. We said was the COVID to econ spread. So this is what it looks like. So a positive measure here would say that he talks more positively about COVID than he does about economic related things. It looks like overall, right, he's becoming much more positive about COVID relative to the economy across time. We don't see that this does anything, though. So it doesn't appear that his COVID sentiment relative to economic sentiment does anything to affect markets. The last one that I'll show you, and then I'll show you a table of just our summaries here, is relative to others. So this is a 2 standard deviation increase of COVID-related sentiments of Trump relative to Mike Pence. So this is saying, right, if Trump is basically like 2 standard deviations more positive than Mike Pence is, we get a increase in market volatility that's almost like 3 times greater than what it was before. So again, the expected volatility on the left is really small, but the relative changes appear to be really large. So just summarizing what we find here is, for the most part, the 3 stock market indicators tend to agree with one another. So we do find that the temporal dissonance, right, so Trump versus himself, appears to increase volatility. Economic versus COVID-related sentiments doesn't really appear to do all that much. Trump versus Pence COVID sentiments appear to matter, so that'll increase volatility. And then there doesn't really appear to be any difference between if Trump is dissonant to his press secretary. So just to summarize these results that we just talked about, so really the largest drivers of market volatility are Trump's dissonance with himself, right? So it's either what he said the previous day or to some extent, right, relative to what he was talking about with the economy. So, and it also appears that there's some amount of dissonance between him and Mike Pence that causes market volatility, but not for the press secretary. We also look at the I didn't show it here, but the daily variance in COVID-related sentiment by Trump, right? So like on a given day, is he all over the place with his sentiment about COVID? There's no real effect there. We also look at economic dissonance, and I'd say that sometimes we find that it affects volatility, but a lot less than these COVID-related dissonance measures do. And to some extent, too, we find that it's not necessarily Trump being more positive or more negative than something else. It's this absolute term, right? So as long as there's some dissonance, that appears to affect volatility almost just as much as if it's positive versus negative. So summarizing these like 2 big projects that I talked about here, to some extent, this is new research on politics and financial markets. I think obviously, like, we're drawing on a bunch of big literatures, but we've kind of been able to find these unique contributions. And really, what our contributions are is that it's not really elites setting policy. It's more of how do elites talk about policy, right? And then how does that go on to affect financial markets? Some of this is contributing to the research on how social media affects financial markets, which is a pretty small literature, but it is growing a bit. There's some contribution too of turning, this is like a lot of text as data projects into political economy time series. So Allison and I have been talking because we really don't see a lot of people turning these text as data measures into something that we could toss in a time series model. And then, of course, we have a methodological contribution of these Garch models are really difficult to talk about. How can we better interpret them? So just this last slide here, where are we going from here? We have a paper that we're working on where Trump tweets a lot about trade and trade agreements. And so really seeing, like, do his tweets actually have these spillover effects to other countries that are affected? So, when he talks about trade and trade agreements with someone like China, Canada, or Mexico, how is that affecting their currencies as well? It's pretty cool because a lot of these other countries, their trade ministers would actually like tweet back at Trump. So that's something that we might check out. We kind of have a basic measure of this COVID-related dissonance, and we'd like to examine other measures of dissonance. So you can get measures of how angry a set of text is or how sad a set of text is. So we're thinking about looking at those two. I mentioned economic-related dissonance. we also have a bunch of really fine-grained data. So everything that we talked about today is dealing with daily data. It's very clear that, Trump tweeting at the beginning of a market day is very different than him tweeting at the end of a market day. So, a next step would be seeing if he tweets about COVID and it's dissonant, how does that immediately affect markets over time? And then we have a paper we're working on with Soren Jordan, who's a professor at Auburn University, on turning our Garch interpretation approach into a program that we can use. So with that, I'd really like to thank you all for listening in. And I'm really looking forward to all your comments and questions.
All right, and wow, this is really thorough, and this is Carl here, and I think this is just just overwhelming. Now your theory sound theoretically sound, methodologically robust, but most importantly, your work is so thorough, and from collecting the data, converting the text into data, and I can also describe it data science smart too. There's some methods that you innovate. Garch is not a new method, but if you use Garch to support the theory of dissonance and the policy, this is new. I never see this combination before or application before. This is really, really amazing. And do you send it to a journal yet? Send it off yet?
No, not the second part. So the second part is what we're actively working
COVID.
on.
Yeah. This is very interesting. I think what we will do is try to maybe Peter and I have some question first, and then or maybe we can open it to the students first. I have a student who has hand up. Mona, do you have a question? Please speak up.
Yes. So first, thank you for the interesting topic. I really enjoy it. My question is that since you were working on this, if we want to talk about how like specific foreign policy and more specific towards Middle East or Iran, like does that also affect the stock market? Or since United States does not rely on Iran's oil, it has been many years that they do not rely on Iran's oil, or just it could be uncertainty in the market, or it doesn't affect anything because your U.S. sending troops to the Middle East and all those stuff that happened at the beginning of 2020. How about those things?
Yeah, I don't. So I think especially with the 2020 the paper that we're working on that's just in 2020, like you mentioned, we don't have a ton of other independent variables in there yet. And I think that's right of there's lots of different things going on, especially in regards to our argument of obviously there's the Fed has been really active in especially early 2020. There's a bunch of other economic things that matter. And then of course there are these other, more international things that are mattering too. We have not looked at those at all. I think it'd be interesting to do so. To some extent, a lot of that literature exists of I guess, not like stated events, but I do know, right, the policy in Afghanistan to pull out troops, right? That was very sudden and unexpected by the Trump administration. So I think that's another good application. I haven't thought of that at all. So I think that's a good comment.
Yeah. I personally have one remark and one question maybe for future research. And now I think that this is quite unique to the Trump administration of his Trump style candidacy to his administration. So one thing is quite predictable is Trump's unpredictability. So this is something that why this paper, these two papers are important, because that is tapping into this unpredictability and then using a model to illustrate that volatility. And this model in this whole research, whole study. So this is really important. I think it's a great contribution, but I believe that could be just most useful for an elite like Trump. I don't know about Boris Johnson. The reason is because you have so much information feed through the Twitter, and also I think the White House statements could be a really good source of data. But this kind of data itself provides some good feed or good source for volatility. But one thing I want to bring into your, maybe I invite your feedback about this is, now imagine we have a system. We impose a shock. So the system itself, we have some kind of self-adjusting or equilibrating mechanism. Just imagine that you have two co-integrated series. So each other will co-integrate, or you equilibrate each other. And in the financial system or the stocks, so systems could be equipped with the hedging forces to absorb these shocks. So these shocks will be short term. There may be, I don't know how short, could be a few days, and could be a month. Then can go back to equilibrium normal. So that, but in your case, you really illustrate, and something could be happening at that moment, and you like to use your third day shock, and I really see that volatility is so obvious. This is something really interesting. No one has done before. No one has, but I do not know how much that could be showing real impact for some heavily hedged systems. For example, I'll be interested in the trade war with China, but the China stocks or China's currency, they are heavily hedged. So such as Hong Kong currency and the renminbi, these currencies are pegged and heavily hedged through their own fake foreign reserve. So these kind of shocks could be easily hedged or could be easily absorbed. That means it's more difficult to detect such volatility's real impact. But maybe you can do research in future. That is something that you can discover in future. But at this point, and I don't know how well hedged or how well protected the peso system is. Maybe Mexican currency, they have their own way of doing absorbing the shocks, and the volatility may boom, and then the next moment or next day the impact is gone. So that will be something that is really worth further study. I really like to see your next work on the trade war in China. I used to do a trader analysis on trade war. Now my question is how much we can really detect the policy, the importance of the policy communication. And now on one hand, and you said, how do you talk about the policy? How do you communicate the policy to make the policy landing an impact to public support or the financial market support? Now it also matters to what we call the messenger effective. So it's not just the policy itself, but who delivers the policy and how the policy is delivered or communicated. Could be another two things that you can shed more light on. And what do you think? And I'm talking too much now. I'm talking too long.
Yeah. No, it's good. Yeah, I think, well, so to some extent, like Trump, Trump is a very unique case with maybe some colleagues right now, on the world stage like like Bolsonaro that are also pretty active in terms of like what they're saying online. But yeah, I agree. Like we haven't had too many problems with people saying like how generalizable is all this. But I do think that's an issue, right? Of like, I don't think it'll apply to all that many people in the future. Although it applies to a decent amount.
Definitely not Biden. I checked Biden's trade. It rarely did not compare to the scale that Trump is doing.
Yeah.
Maybe I can. Yeah. I mean, I can read another question from a student. Student is more important now. And a student might ask, have you compared the data with Trump's market value when press are taking place? Does it all have an impact, just like the stock market? Yeah, I think this is a... let me reread the question. Maybe I think maybe some words he is missing. Have you compared the data with Trump's market value when press are taking place? Daniel, are you? Do you mean that this is like he's doing the press conference instead of doing it like a tweet? And I'm not. Yeah, like a Twitter post. Okay. So what do you mean by Trump's market value? Okay. Daniel is rephrasing his question. So
can you guys hear me?
Yeah, yep. Go ahead.
Okay. Apologies.
Go ahead.
So yeah, it's pretty much comparing like how you did with the stock market whenever he tweeted with his post. Have you looked at any of his businesses to see how they impacted as well?
Yeah, that's a good point. I don't know if I don't think any of them are publicly traded, but I'm not positive on that. But I think that's interesting. I know, like, you know, so I said earlier, like, not a lot of people, or some, like, there is a little bit of literature on him tweeting about certain companies, and then that has actually, like, you know, been kind of shown to affect certain companies. You know, when he like disses Toyota or someone about like building or not building a plant in the U.S. So I would guess, yeah, that there'd be some sort of spillover effect, but yeah, I think that the data might be hard to get there.
Yeah, good. All right. Blake, go ahead. You have another question, Blake?
Hi, can you hear me?
Yep.
Yes.
I just wanted to ask how you were taking into account whether or not these changes, specifically with Trump and the U.S. stock market, whether or not these changes were going to happen anyway, and maybe Trump was reacting to that. He maybe knew these changes were going to occur. Do you know what I'm trying to say?
Yeah. So I think like so what we ended up doing in the tweet paper as a little bit of a way around this was to kind of we were looking at like when markets were closed versus open, and so if he tweeted and then markets were closed, right, like that's not the markets necessarily like immediately responding. It was just after like a lag. I think we really didn't get too well around that in the tweet paper. I think the way around it in this new paper is not with the daily data. I don't think that could answer, right? The issue is this like simultaneity question of event happens on a day. Trump is saying something about the event, or, you know, tweeting about the event. And then also like event is affecting the markets. I think the closest way that we could get around that is what I briefly mentioned in the conclusion with, we do have this data that's minutely. And so we can really say like, you know, he's going along, he tweets. We don't have speech data. It's not time-stamped. So that's kind of a bummer, but we do have his tweets. So, right, like it's going along, he tweets, and then immediately we can see the market react. And so assuming that nothing else happened, you know, at that exact moment in time, that's our best like causal strategy for getting around the simultaneity issue. But it's a it's a big concern when the data are analyzed at the daily level like that. So that's a good point.
Yeah, intraday impact. I think I should invite question from the Taiwan side. Hello, Peter. Do you
Hi.
have any question from your students and from your faculty?
Yeah, just a couple of here. One of it is that close to what you have mentioned. Well, personally, I have to have I have to say that I'm really impressed by the and the very subtle framing of the research question, as well as the operationalization of the measures. I think this is I'm impressed. Thank you for sharing that with all of us. So the question goes like. The traditional arguments about how financial market works is what your hypotheses are based upon, right? So against the financial traditional argument. So the question is that does it apply to other national contexts, such as those of more planned economy? Carl just mentioned that maybe China or some other developing. So where the central government plays a more active role in the financial market, so the volatility is kind of being controlled or pegged. For example, the currency is pegged. So the measure is quite difficult, right? So to a great extent, that we consider that maybe this and the second part of the question is that we consider it quite intuitive that a national leader's remarks affects the volatility of the financial market. So does it? It seems that Trump is a very special character. So he tweets a lot, he talks a lot. So it makes more sense that you try to relate his tweets the market. But how about if we put this in other contexts? For other national leaders, Japan or Canada or someone with more traditional politicians' styles than the remarks or comments or formal, right? So pairing with Trump's style. So that's the two parts of the question. Inside with us. Thank you.
Yeah, no, those are good questions. Yeah, I don't know how it'd work in a planned economy or like Carl was saying too, with just like a fixed currency. So Mexico is a little strange because I believe they're fully floating, but also they are they're like a hedge currency. So investors trade like crazy in the peso. Same thing too with like the Turkish lira as well. So like Turkey might be another place where you have a relatively like strong leader who is very outspoken. You have a currency that is used as this hedge currency. That that's another good place where we might find something. As far as a planned economy, I mean, I guess what I would suspect would be like this sort of stuff would still occur. It would just be so slow moving that we would never pick it up in the models. Would be my guess, but I mean, I think it's an interesting idea. I think for the other, so the other question was mostly on like, are there other leaders that are exactly like Trump? And I think the answer is no. I mean, maybe, maybe Bolsonaro, maybe AMLO in Brazil. I think like something that's interesting and I don't know if it would rise up to the level of a national stock market, but something that we've talked about doing is, if you're like looking at Twitter, like Trump is going back and forth all the time with like state governors, and so that's a huge source of dissonance as well because he's telling them to open, they're saying no, we're closing. That's another source of dissonance to the extent that other, again, I know Brazil a little bit better than other places. Maybe I don't think I know Brazil very well either. But right, like I think there were some places where you'd have like city mayors saying, "Oh well, we're closing down," and then the leader is saying, "Oh, you need to stay open." then like judges are getting involved, and so yeah, Brazil might be the other good place that I can think of, but it's hard because then the stock markets tend to get a little bit smaller, and they're probably more volatile on average as well. But yeah, I think like the moving more internationally is definitely one of our next steps, either in regards to Trump affecting other countries, or how do leaders in their countries affect markets as well.
Yeah, the question comes from we try to borrow this good idea or insights and try to apply to a different context. So that's where the question comes. Yeah, like you said, maybe contextual factors. If we consider this in the market, they would.
Sorry, Peter, are you breaking up? And can you repeat the last two sentences? Hello, I cannot hear you. Somehow maybe the mic is.
Yeah, can you hear me now?
Yeah, it's better now. Go ahead. Yeah.
Oh no, that's just some remarks and my response to Andy's what we just say. Just the question comes up to contextual, right? Because we're trying to students, faculty here, and we always come up. The first questions in head is that how can we apply this model to our context, and then so that's where the question comes up. So maybe the next step for you or us, and we can think of different contextual factors, and then we try to factor into your model and see if that applied to that. That's just my remarks. Thank you.
Yeah, let me write on that too. I think you moving this research to international topic. For example, how Trump's remarks or Trump's tweets will tie to other governments or other leaders' public support, for example, and how, particularly in Taiwan, how that is related to President Chai, which is the Taiwan's president, Chai's other policies such as the arms sale, and Trump also rolled out a series of bills and are actually becoming law to support Taiwan now, and how that will shock the what we call triangular, trilateral relations between Taiwan, U.S., and China. So I do not know how can get the data, and maybe we can get it from the press or the announcements, and there could be some event data we can tap into. But how do we put into, maybe you can give us some advice how that could be applied to studying the trilateral relationship or the Taiwan president's public support and etc. And maybe this is something you can chime in. What do you think?
Yeah, I mean, I think, and this gets a little bit to Mona's question, right? Of like, really these not necessarily. I mean, they're events, but they're they're not exactly the big policy events that we were talking about. But I think they'd still matter. I know, like one of the, like one review that we've gotten before has been with the almost doing like a system, almost like a system of equations of really like you're trying to model almost the entire economy. And so it's things like, and especially if it was between multiple countries where it's like, we have these financial indicators that matter. We have these unexpected, dissonant policies that matter.
Yeah.
We have other types of, so that was like related to COVID. We have these other dissonant policies as well, such as like, right, arms sales, different agreements falling through or changing.
Yeah.
So I think it's a matter of it's hard to model all of them, but you
Yeah.
could definitely model some of them.
Yeah.
But I do like you had mentioned it a bit, and I think it's worth considering. It's something that Allison and I have talked about, of doing like multiple, right? There's like multiple countries. Obviously, the markets are all well integrated for the most part too.
Yeah.
You know, like something that's happening in the U.S. could theoretically affect Taiwan, or or things that are related to U.S.-Taiwan relations.
Maybe you can think about the whole market is like a circular time series. If you connect to for example, the Asian markets, and our market is like 9 to 4, right? And 9 to 4, then began the European market, then began the Asian market, that become a circular time series. Then we can do more like a circular time series. This is another topic, because we're still limited by the intraday fluctuation. They get average, right? Now earlier you mentioned that you can do the minutely time series, so they can see more fine scale fluctuation of volatility within each day instead of averaging one day. Yeah, that would be some suggestion. I have a question from another student, May Barrera. You mentioned other factors such as immigration as a preferred topic when looking at unexpected speech. Do you know how this particular model would apply to other issues not related to the effects on the market? Yes, another application question. Yeah.
Yeah. So really, I mean, right, this question is asking, could that sort of the constructed variable be used on a different dependent variable? And I think the answer is totally. So I would encourage you to do it. Yeah, like, I mean, some of this stuff might be like sentiments about building the wall, or like changing immigration policy in the U.S. Obviously, his discussions affected sentiments in Mexico as well. There's no reason why you couldn't do that as well. No, the text as data stuff is pretty open with what you want to do. But like I did mention before, I think what surprised Allison and I is, with the exception of some work in especially like American public opinion, with a lot of this stuff that like Chris Valasian and Stuart Soroka and what those guys are doing with lots of like newspaper media, like scraping that and turning it into a time series. Like, we really haven't found a lot of people that are taking data that's text, grabbing it, doing something to it, turning it into a time series, and then either having that as their dependent or independent variable. So yeah, I mean, I totally encourage you to go out and try it if that's what you're interested in.
What do you think about using other trader responses as the dependent variable? I think it could be quite heavily entangled. It's not easy, but it could be another possibility. Someone can tap into the social media responses and then make it into your dependent variable. So instead of stock prices, but hard part is they are so highly network, highly connected. How do you sort it out into like an index? And maybe you can suggest something like that, using Twitter as a dependent variable also.
Yeah. I don't know with like how easy it is to get actual response. Like, so like if he tweeted, right, you're saying like if someone commented, you could definitely tag, if you had the user, you could see if they were retweeting something that he said with a comment. So that would probably be my best guess of what you could do. Yeah, that's almost like more of a networks question.
Yeah. One thing with maybe there is a favorite like a like in the Facebook and in Twitter. And if you can get enough data to get the favor, or but then with one direction, because in Twitter there's not like a dislike, and in Facebook, so that is hard to get both directional, or you can do that like a volume of favor or a like clicks. So that will be one option. But yeah, I think May, do you have more follow-up question, May?
No, I don't have any follow-up
okay
questions.
Good question. Thank you. Good question. And Peter, do you have more question from the students on the Taiwan side?
Not for now.
Yeah,
No.
I think I still have a lot of questions, but I think this is really, really valuable moments, and we can learn from your really good research, really a great research, and really eye-opening, illuminating to me. And now I want to open up for more questions from the US or Taiwan side. If not, I think we can let Andy conclude. And I really want to thank you again. This is really illuminating again, and open up our eyes on how using social media data, and looking at not just the mean variable, but also the variance variable, and the Gauss models. And this is really interesting, Andy. Thank you. Yeah. All right. So do you have any concluding remark, and Eddie?
No, I mean, this is high praise. You all are so nice. No, I think this was a really fun project with Allison. I think the data stuff is not all that easy to do. But I do think, especially working with her, I think I briefly mentioned, she used to work in lots of financial risk consulting. So she's well versed with investors are doing this. That's why we're observing this, which has been great, because normally I'm at a loss here. No, I think I'd encourage you all to, those of you that haven't done a lot of text as data, not that I'm an expert on it by any means. I have a colleague that we just hired that's what she does. But it's just cool because there's lots of new data that are out there that people are starting to use. I think especially for time series, where I know Carl knows we're really lacking in terms of observations, and so having 800 observations is a really fun thing. I think it's a good opportunity, and I mean, those of you especially that are PhD students, you coming up with a novel data set that's something that you created, I think is a good idea, and you have the time to do it.
Yep. All right, and if you can, maybe you can send us your any sample article, then we can put it on a GitHub, so we can let some of the students read that, and that would be great. I particularly want to bring to the audience, attention about your AJPS piece on time series. That is a really good roadmap if you are really interested in time series analysis. And Dr. Phillips is a really, really informative piece, and talking about how you can make decisions on what kind of method you maybe you can briefly talk about that. Yeah.
Sure.
Yeah.
So this is a paper I wrote in grad school. I can hand it to Carl so you can put it up on the GitHub. But really, it was just if you spend some time working with time series, we have a big decision to make, which is really, is a series stationary or does it contain a unit root? Like I just mentioned, right, we have lots of series that are really, really short. So if you have 800 observations, it's really easy for me to tell you whether something's stationary or not. If you have 50 or 60 observations, it becomes really hard. And so I try to walk through how we would go about like diagnosing our model, and really like it involves starting with diagnosing the dependent variable and making sure you have that right, and then that kind of leads you to there's like a diagram is I feel like the big part of the article, because you kind of start with the dependent variable and then you figure out what's going on there, and then you go to the independent variables, and then it talks about a co-integration test that you can use that we programmed, and then kind of building off that is a lot of stuff similar to the plots that you saw today. So that's stuff that I've been working on with Soren. The Stata program that I wrote is, well, he and I wrote it, but I did the majority of the Stata one, and I think that's okay. But he did the majority of the R version, and the R version is great. So if you do have a time series, right, a single univariate time series, it can run pretty much anything as long as it's univariate. You have regressors on one side, and you have a single dependent variable on the other side. I think it can run most types of things that you want. So I think that's cool. And there's a lot of new time series stuff too coming out. So
great.
Always fun.
All right, and I think your article is titled "I Have Your Cake and Eat It Too." That is a fun article to read, and also it is very informative. I use that part for my data visualization class, and showing students how you should draw a roadmap and when you have variables. All right, I think Peter, do you have more questions while we can take advantage of the last few minutes? Peter?
No, but I just want to say thank you. Thank you, Andy, and for this wonderful presentation. And also, Carl, you mentioned that you have the visualization. Use Andy's article for your visualization class, right? Remember, we have appointment, right? We have appointment for you to share the visualization class. So why don't you just use Andy's stuff and then show it to us?
I definitely showcase what a great visualization that you can use, and I would definitely use that as an example when I teach the workshop.
Yeah, that would be great.
I will cite you. Don't worry. I will cite your piece. I'm going to teach a workshop, and later this month to the Taiwan students. I would definitely cite your piece. All right. I want to thank you again, Andy, and I have a lot of remarks from the students. And yes, we will post this video on the YouTube channel of the Colloquium YouTube channel. You can watch that again. And I cannot thank you enough, Andy, for coming to present your research. This is really impressive. And again, I want to also relate the remarks from the students. They enjoy a lot, and that is really good. All right, and I think I can wrap up at this point. Peter, what do you think?
Yeah, thank you so much.
Okay.
See you very soon. All right, in person or online.
All right, thank you, Andy. I hope you enjoy the grading and stay warm in Boulder. And
thanks everyone. Thanks to Carl and Peter. I mean, this was great, and I appreciate you either coming out early in the morning or late at night for those in Texas.
Yep. Yeah, indeed. Pleasure of all hours, and we are really, really honored. All right, thank you, and I want to say thank you for everyone who attended this event. Please be reminded we will have another event next week. Professor Guy Witten of Texas A&M will be delivering another speech titled "Dynamic Pi." This is I think. Andy, Professor Phillips, a contribution to that project too. All right. So after then, December 17th will be Jeff Guild delivering a speech on Bayesian research in data science. All right. Thank you so much. Be sure you register these events, and if you have any questions, please let us know, email us, or visit our website, dacolloquium.com. Also, you can do the same, type in the keyword in YouTube and visit our channel to get all the previous videos. All right. Thank you so much, all. Thank you again, Professor Phillips.
Thanks, everyone.
Thank you. Peter. Bye.
Hello, Professor Ho.
Yes, I'm still here. Yeah.
Hi, it's Kirsten. I was just checking to see if you